just shot like 7 minutes of us trying to do live, and obviously naturally would be
Half
remiss
focused.
if we
Yeah.
didn't hit technical difficulties. So we'll try and recover some of the things we just mentioned. But my interest I mean,
I still
you and
don't see it up though on
yeah, it's
YouTube.
showing on the back end here that it's live. It might just take a minute. Like LinkedIn
Oh, there you go.
still,
Yeah.
yeah.
Okay. Perfect.
So the like you and I like to riff on macro a lot, and like my interest in macro is obviously uh it is interest rates, right? Like real estate, housing is the most interest rate sensitive asset class, I would say. I think like the easiest way to really understand this is Michael Cantro's hope cycles, which basically
Hmm.
shows that as interest rates go up, what responds first? Housing, right? So the housing market, everybody's buying properties in Canada and the US with mortgages. If rates go up, it reduces their buying power. It gets hit first. If they're buying less houses, they're buying less decks, lumber, contractors, et cetera. So that's slower orders for consumption goods, less furniture even. Um, it's also a wealth creation engine. So I think there's a negative wealth effect as a result of that. Then profits get impacted by fewer orders from these businesses that are providing those goods. And then finally, as businesses have less profit, you get the employment impact. And right now, I think in Canada, we're just seeing the employment impact of that, the rate hike lag, right? Like unemployment's rising. But we're going to talk. So we're going to talk a little bit about that. But we're also going to talk, I think, about just like general
Hmm.
oil price shock, how oil prices have kind of like preceded a lot of last recessions, which I pulled up this chart before when we were
Yeah.
chatting. Oil price shocks, a big spike in inflation seems to lead into recession in many cases. So talk to me a little bit about that and like what your case is.
Hmm.
I think it sounds like we're pretty much in agreement, but I'm curious like if you want to outline your case.
Yeah, I mean, I think I did some research too, and usually oil shocks will tend to slow down the economy. Whether it leads into a recession or not, usually will depend what the state of the economy was before the actual oil shock happened. So we saw, I know a lot of people will kind of look back at the 1970s. I know you have that on your chart there, but let's keep in mind that in the 1970s too, it was a very different situation. You saw the US, amongst other countries, spend a whole lot in the 1960s. 1971, they went off the gold standard. And then you saw a lot of fiscal spending during that time period. You saw inflation starting to pick up, and then in 1973-74, with the first oil shock, really got exacerbated by that. And then you saw the worker as well being in a better position, I think, to negotiate higher wages to keep up with that inflation. I think right now we can definitely debate on that, but my argument would be that right now workers don't have that much bargaining power. Depends on the field, I would say. It's probably not, shouldn't say that as a blanket statement, but at least white collar workers with AI and what we're
Yeah.
seeing in all the layoffs, even if inflation picks up in the short term, they probably won't be able to offset that. And then obviously when you have an oil shock, I think it's pretty simple to think, okay, you see the gas pump prices. I don't know if you filled up your car, Dan, probably because
Yeah. I got a
you
big
drive more
diesel
than I do.
diesel truck. It's bad, man. It's
Oh yeah,
bad, bad,
diesel.
bad.
Oh man. But even I have to put premium in my car, so it was over $2, and we
What do
don't
you got? Like
drive all
you
that
got a
much.
Lambo?
No, just an Audi, an old Q5 that needs some
They
premium
need the
for the
premium the most for sure.
for the turbo. But what you're seeing, like we can't afford, we don't drive all that much, but I think what you'll see for a lot of consumers in Canada, but I think across the world, it's not specific to Canada, and you'll see that in the US too, is you'll just start seeing consumers that have to spend more on gas start cutting elsewhere. So yes, short term, you're going to see higher inflation. I mean, we just saw it with the US. We saw inflation, I think I had in my notes here, go from what, 2.4% in February to 3.3% in March. Core was largely unchanged, slightly up, but just 10 basis points, so not too much of a change. But you saw energy up 11% and gas prices up 21%. So I assume you'll be seeing that. Yeah, exactly. So I assume you'll be seeing that with Canada too when they come out next week. I don't know what the estimates are, but I assume we'll see higher inflation. So I think for the most part, what I've been reading, and it does make sense, is you get, yes, inflation spikes short to medium term, but long term, you get some downward pressure on the economy because those consumers that have to pay more for gas, more of their not, they have budgets that are finite, right? They
Yeah.
don't have unlimited money. Well, you have to cut somewhere else, and that cutting that you do somewhere else will impact somewhere else in the economy, and then eventually the whole CPI basket starts seeing some downward pressure in the economy as well.
Yeah, yeah. Actually, the Fed actually put out a paper that mentioned how gasoline demand is more responsive to price changes than economists once thought. I don't know if you ever saw that paper, but that was in like 2020. But I think it's interesting because we just went through a big bout of inflation, right, in Canada and the U.S. during the pandemic, and what makes this different than, like, why is this one likely to lead to demand destruction rather than the pandemic? Well, in the pandemic, I think the key differences are, the pandemic, you had a lot of people had the ability to reduce their exposure to things like fuel because everybody's working from home. We weren't traveling as much. I mean, I remember that period of time. You could drive somewhere, it was like the roads were empty, right?
Oh yeah, there was no rush
Um,
hour. It was
no
awesome for that,
traffic. Yeah. So
especially if
yeah,
you're
like
in
you could get,
Toronto, right?
yeah, you could
Yeah.
get anywhere in the GTA in like 20 minutes. And so that was a big key one, obviously. There was also helicopter money, and interest rates were, the overnight rate was 25 basis points in Canada. So there was a lot of people taking on debt to deal with the inflation. But the other thing was that the magnitude was massive, right? We went from 2% to 8.4%, and it was transitory, as we were told, but it didn't jump instantly like what you see as a result of an oil spike where it's month to month, right? It climbed from 2 to 3 to 4 to 5 and 8 over a year, right? It was a long, drawn out increase, and so consumers have the ability to adapt and change their financial plan. Whereas if inflation goes up, if it goes up by 1.5x on a month to month basis, you don't really have the ability to immediately or like proactively change your personal financial picture, and it causes a big, I think that's what makes it lead to demand destruction, which ultimately ends in people having to immediately scale back their consumption of fuel, but also anything that uses fuel to get to them. So all of their consumer goods, durable goods, businesses who are seeing eating their profit margins. Like if you're a contractor or whatever, and you have to get your guys to site. Well, now all of a sudden, if your fuel costs just went up substantially, um, everybody's profits start shrinking, and that becomes recessionary, right? So this is why, I pulled up that chart about the history suggests that oil price shocks are typically lead to recessions. I think like almost every major recession that we've seen in the last little bit was preceded by an oil price shock in some way, right? Like if you look at that,
Mhm.
I think there isn't, other than COVID, there was basically every single recession had this as a theme. And I guess the late 80s, but that was sort of after that double dip inflation and the huge, that was your Volcker era, right?
Yeah, and the biggest, I guess, risk, and you're well aware of that, I know, but the biggest risk right now for Canada is how indebted we are. All of
Yeah.
those other recessions, we did not, our indebtedness level was not that high, and I think that's where people tend to correlate recession with oil shocks, is because usually it'll happen because the economy is already not doing all that well, and then you just have this that hits, and then it's enough to slow down the economy. But I think that's the biggest risk for Canada, is consumers are just tapped out. And I was looking at Stats Canada earlier, and I think some part of Canada or Canadian households will be able to deal with it, but it's probably going to be more than 20%.
Yeah.
So we're not
Yeah, at the,
really
at the margin, I would agree. Like like Ben Tal did some research on this. I pulled it up on the screen,
Mhm.
but basically, like, he mentions that we're way more sensitive. I think it's like 2x more sensitive to interest rate increases than the US because we are way more indebted. Our household debt is like one of the top five in the world, typically, sometimes number one on a month to month
Yeah.
basis. What is it,
I think we
180?
compete with Australia, right? Something like
Yeah,
that.
Australia, Switzerland's pretty bad. The Netherlands, but yeah, like, we're up there, right? It's one of the few things that we're excellent at is levering up. So yeah, I think that's going to be. So then kind of begs the question: how does this push into the rate environment, right? Like, you
Yeah.
watch the bond yield, and bond yields, they spiked quite a bit. They were at their highest in over a year for a bit there, right?
Mhm. Yeah, yeah. I mean, I think bond yields, they've gone down. I think they've mostly gone down with what we see. We're seeing the headlines, developments in the Middle East, so we'll have to see that. But the U.S. 10-year is still much higher, and that's what's going to drive the Canada 5-year as well, right? So it's much higher than it was at the beginning of the conflict. I think it's still, even with what we saw today. So it's 4.22 right now. That's still about what 30 basis points since the conflict
Yeah.
started, roughly 25, 30. And then obviously the Canadian 5-year bond yield will move pretty closely to the US 10 years. So I think you're seeing that. And what is it exactly? I think from my perspective, what I've seen, it could have been initially a rush to her liquidity. So you
Yeah.
had, especially for the US 10 year, you had countries, sovereign, trying to get US dollars any way they could. So you sell the most liquid assets, whether that's stocks, whether that's US treasuries, whether that's gold. So we saw a lot of pressures on those assets. But as the conflict drags on, and then now as oil prices kind of slow down, there's some better news. You're going to see the 10-year kind of vary a little bit, and of course the 5-year in Canada vary a bit, but it's probably going to be putting some upwards pressure. Is it the market seeing potentially more inflation, or is it the market kind of pricing in that governments will have to respond sooner or later with some more fiscal stimulus? So whether it's people often forget, but think about countries in Asia. You're thinking about Ireland with some of the fuel shortages that you're going there. If you have some richer countries that are in desperate need for oil, um, they're going to try to get it any way they can.
Yeah.
So whether that means printing money to be able to have the highest bid, whether that means subsidizing your population so they can afford those higher prices, at the end of the day, you're going to see some pressure on fiscal spending, especially if then we start entering a recession. Governments will spend to help the economy. So it's not looking great. So it could be a reflection of that the bond markets are anticipating that governments will have to spend more. And we saw with the new majority government in Canada, with the removal of the excise tax on gas, or at least a temporary removal until Labor Day. I mean, that's going to mean lower revenue for the federal government. So I know it's maybe not huge, but it's another thing that will put some upwards pressure on the deficit.
It is funny because, we had this whole idea that like taxes were going to go up like crazy. I mean, this is already your fiscal side, obviously trying to stimulate. Like they really already are pulling out policy to try and stimulate the economy, right? By reducing taxes, not just on fuel, but we saw in my industry, like the federal government and the Ontario government just reduced GST, HST in um, new build homes. So they first eliminated it for first time home buyers, and then they actually increased the policy across all types of home buyers for brand new homes. I don't know if like anybody had that on their bingo card, that we were going to see massive like tax reductions coming from the federal government here in Canada. Right off the bat, like within a couple of months of or sorry, within a year of Carney being in power. But I guess it's desperate times call for desperate measures. Probably, I don't know, like where your thought. This is stimulus, right?
Yeah, I mean, I think they're going to try and do whatever they can, right, to boost. Like I know you're more familiar. I'm not as familiar with what they're doing on the housing side. That's more your forte than mine. But for me, it's just logical, right? You're going into the downturn. They're going to try and stimulate the economy any way they can. I mean, he's a former central banker. He's well aware of the playbook, and I think that's where it puts a lot of pressure. Just to get back to bond yields, I think it puts a lot of pressure on these bond yields, because that's what we've seen the last 4 or 5 years. Is we spent, and Canada's not alone, like drunken sailors when the economy was doing well. Usually you pull back spending when the economy is doing well, and then you increase it when you enter a recession. Well, what happens when you keep spending and then you get into the recession and you have to spend even more? So I think right now, from some of the people I follow in terms of liquidity, I don't know if you're familiar with Michael Howell, but right now it seems like we're a bit in terms of turning point in terms of liquidity cycle worldwide, and bottoming out on from that perspective. But I think he sees late 2026, 2020, early 2027 at that rolling over, and it's probably going to be a result of stimulus coming from a whole lot of different governments around the world.
So if we see stimulus, then this is sort of admitting that, I mean, even if we're not seeing recessions on paper, that the governments and central banks aren't confident in the quality of the economy, right? Like they're the growth of the economy. And so,
Mhm.
I mean, this, I guess we I think we discussed this before when we had the mishap with the lives, but like, is your case, your thesis that basically short term obviously is a fast spike in inflation, and then that causes demand destruction, and then we end up in a pullback in consumption and more recessionary territory, and we're more likely to see rates come down in the 12-year horizon rather than up,
Yeah,
or
yeah, I
12
think you're
months,
gonna
sorry.
see. Yeah, you're gonna see banks like obviously. I could be wrong, but my base case is you'll see banks being late to the party. Central
Mhm.
banks, like they usually are, they probably won't do anything for the next 6 to 9 months, and then I expect that they'll start cutting. I was looking at the Fed's fund rate. That's what they're pricing it right now. So it's 50-50 chance that you'll get rates at the same level or a rate cut, right, by the end of this
Yeah.
year. So it's like a coin flip.
Yeah,
So I
and the
think,
bond market's kind of the same thing, right? Like it was kind of before, it was like, at least in
mm,
Canada, like a little bit more likelihood of upside to rates than downside. But now and you're still kind of seeing that. But I mean, the one thing that I find funny whenever we talk about like the bond market and Fed fund futures of like of rate forecasts is I always inclined to look at this chart that I have up on the screen here. It says that market forecasts are almost always wrong about the future
yeah,
path of the Fed funds rate. So like it's, take it all with a grain of salt, obviously, as well, right?
yeah, exactly. I think was it in 2023, 2024, the Fed was going to cut rates in the next 3 months for about 2 years' time. So
Yeah. 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 Exactly.
Uh,
Exactly.
yeah, so I mean, I think you have to take these with a grain of salt, but it just goes to show that market expectations have shifted. And if we're looking at Canada, I mean, the economy is not doing well. We
No.
saw so far this year, Q1, jobs have not been great. Sure, last month it was what, like up 10, 15, 20,000, something like that, just
Yeah.
going off memory.
But
And the
February was like one of the
yeah,
worst monthly
was
job cuts in,
disastrous.
in Canadian history, right?
Yeah, exactly. So
84,000.
it's not like it's going well on the job front. You're
Yeah.
constantly seeing headlines of companies laying off people because they're able to replace them with AI. The poster child for that was Square or Block, I guess
Block.
their
Yeah.
name now. Yeah, Block a few months ago that reduced like close to the half of their workforce because they could replace it by AI. So yeah, you're showing the decline in 84,000. So I think in Canada it's going to be like I think Canada is not in a bad spot compared to a whole lot of other countries in the world. I think
So
it
this
doesn't
is
mean
one
it's
of,
in a
yeah.
good place. It
No, I
just
agree.
means it's not as bad. Yeah.
Well, and this is where, like, if you kind of go back to what we were dealing with, a couple of months ago before the oil price thing became sort of like the primary fear factor in the economy and the war in the Middle East. Before that, it was, what were we looking at? We were looking at trade war, right? That having impacts on Canadian exports, but also impacts on the price of goods through cost push inflation within Canada. And every central bank paper in Canada was analyzing this, and all the monetary policy reports on a quarterly basis. We're talking about the uncertainty as a result of the trade war, and so we went from trade war to real war. And in trade war, Canada was kind of one of the ones that was like uniquely, or like we were central in that, right? Because the U.S. is our biggest trading partner. If we're going to be highly impacted, we're probably going to suffer more than a lot of the other countries that don't have as big of a trading relationship, but are still included in this trade war. Now, when you get to oil price, and it becomes this sort of like blanket impact across the world, where no country consumes goods that aren't shipped by vehicles that use oil. So there's cost push inflation risk to everybody across the world. Now all of a sudden Canada actually looks, there's a couple of factors. So we have the petrodollar, obviously,
Yeah.
but
Hmm.
we have an oil industry. So there's potential for some near term economic growth in certain sectors, not in all, right? But last time we saw a big oil price spike like this in 2008, like I live in a small town in the GTA. I grew up in a small town in the GTA. Like a lot of my buddies everybody was moving to Alberta, right, and living in the
Yeah.
in like in Fort Mac and Red Deer to chase the big money out there. So that I mean, there's a reasonable economic case to say that, again, not that Canada is going to do well, but it might do a little bit less badly than a lot of the other countries, I think, in the world.
Yeah, and we're a net exporter of oil too, and I think people often forget that. And that what that means is it's going to increase demand for the Canadian dollar too, with I'm not saying the Canadian dollar is going to perform awesome against the US dollar, but it may perform better than other currencies. And if you see the Canadian dollar hold its own a little bit better, you could offset a little bit of that inflation pressure. Not a whole lot, but it might fare better than other currencies that don't have that extra demand coming in. And look, Alberta will undoubtedly do well, but the reality is we just don't have the infrastructure to really increase the output. I think there was a little bit of extra capacity with the Trans Mountain pipeline, but not all that much. I know when I did some research just looking into if rail would be an option, a lot of the railways had just decommissioned a lot of their I don't know what they're called, but basically what they use to transport oil. So that would take some time to get back online, but the higher prices clearly are tailwind for Canadian producers. And I mean, I added to my oil stock positions like a few weeks ago, and I still think we're going to see elevated prices for quite some time, just because there that disconnect between the Strait of Hormuz and ships leaving about 6 weeks ago, the final ships arriving now, and despite the headlines looking good, you're going to get that oil shock, that supply shock that will be starting to hit more and more severely in the coming weeks, even if it reopens fully, like Trump is saying. But back to Canada, I mean, I think obviously oil stocks should do well if oil remains elevated, and that's good for asset holders. But I was looking at stats from Stats Canada, and Canada is not much different from the US. We are in a K-shaped economy, and the 20% wealthiest household account for 2/3 of Canada's net worth.
Yeah.
And then if you go at the bottom 40%, it's 3.1%. So the rest of it is the 40% that owns about 30%. But all that to say, and a lot of these assets obviously are real estate assets that have been stagnant for the better part of, let's just take Canada as a whole. I know it's very regional, but a lot of these assets have been stagnant. So it's not like households can really afford that all that well. So yes, it should be bearable and benefit some, but Canada is no different than the US. Maybe it's a bit less pronounced, but it's still a K-shaped economy that we're looking at. And to answer the question, loading up on CNQ, I mean, it is a stock that I own. If I didn't have the position I wanted right now, I'd probably be adding a bit, because I think the markets are a bit too focused on headlines and not really what's happening on the ground. Like, I follow some Middle East analysts that are independent, and what they're seeing on the ground is very different. That's what's happening in the headlines.
Right. Like that. Did you see the guy from Citrini who like literally went to the Strait? Like they gave him like 15K USD cash for bribes, and he's like doing like selfie videos on like speedboats and stuff. Did you see
No, I
this?
didn't see that.
Oh man, I gotta find it. Yeah, it was like on all the finance meme accounts. It was excellent, great entertainment. But he was literally just like, we're trying to figure out what's going on actually in the Strait of Hormuz, and I guess it wasn't actually like a blockade, right? They were just like charging people to go through, I think, is what he
Okay.
determined.
Yeah.
But yeah,
Yeah, you're still not seeing like something people can just check is just there's a bunch of resources out there. You can see like the actual flow of ships. And to my latest, the latest stats I saw for flow of ships is you're seeing like high single digits to low double digits going through versus in the hundreds prior to the conflict starting. So it does not take a mathematician to know that that is going to create some issues. And even if Trump tweets some F-bombs and says the fucking strait is open, it doesn't mean that ships will actually go through. And I don't know if it was the start of our failed stream that we talked about that, but
yeah, I think you were talking about at the beginning of the last one, like the number of that's one of the things you were paying attention to, was the number of ships that was going through.
Yeah, exactly. Because if you're a ship owner, are you really wanting to risk one of your tankers? Do you want to be one of the first one to go through? Or what if Iran changes his mind and now starts shooting at your ship? Like, the risk is really, really great for those ship owners. And there's obviously an insurance component to that as well. So I just don't think that it's as simple as it's open, a proclamation from the Orange Man and supported by Iran, that you'll actually see more ships going through.
Yeah, I think, I mean, if anything, you know, it would make sense to model for like, what's the worst case scenario? Like, you know, if I look back at historic conflicts of this nature, there was really no like when did any of these ever happen quickly? You know, when they pick a fight
Mhm.
and you know you have a destabilized government and a country in turmoil the whole destabilized region and I mean like you know Iran was there was attacks on other countries in the area. Like this isn't just going to end. I don't think
Yeah.
it imminently, and it doesn't sound like they're really playing ball. So I would imagine if I'm trying to make a position, either as a real estate investor or as an investor in stocks, I'm thinking, okay, is this position something I would still do if the oil price, if the war went on for another 2 years, if oil prices continued spiking, went higher from where they were, if demand destruction took place, if we were in a recession, am I still happy with the investments that I'm holding?
Yeah.
And that's what we're encouraging to people. Like everybody calls me a
It's
bear because
tricky.
I'm always
It
saying,
is
yeah, it
tricky
is.
because I mean, as much as we're looking at an oil shock and a supply disruption, like what if demand destruction is just greater in the next 6 to 12 months
Right.
and offsets a whole lot of that? Maybe prices actually start coming down just because there's so much demand destruction. I really don't know. All we can know is what we're seeing right now, and the reality. I've been reading a whole lot on this topic. I'm not a Middle East expert, but I try to read both sources that are a bit more pro US and then those that are a bit more like anti the conflict. And then you also have the independent sources. And one thing I realize is of all the countries in the Middle East and all the actors, the stakeholders, whether it's the US, China, Russia, you add in some of the world powers as well in there, even Europe. Um, a lot of countries have different interests or have a different view of what they want or different outcome that they want to see with the Strait of Hormuz. And I think I've heard a lot of people just say the US always gets what it wants. But I think they're realizing that it's not as easy as they thought. It's not Venezuela, right? It's not,
Yeah.
it's not going to be an overnight kidnapping and then
Right.
they decide what to do. So it's just, there's just so many factors at play that I think it's going to take a while for things to get back to normal if they get back to normal, and I think that's a big if.
Yeah, I have no reason to disagree with you on that one. So then what does it look like? Because you know, it's like obviously I think there's a lot of geopolitical factors at play here too, which is, you know, how does this threaten or how does this work with like, you know, we've heard a lot about like de-dollarization and the end of US
Mm.
hegemony and whatever, but I'm not necessarily one of the folks who have bought that thesis per se. And you know, the I in BRICS now is involved in this conflict. And so, or I guess not because it's India, but you've got
Mm.
you know, China obviously buys a lot of oil from Iran. You know, is this like a subsidiary or like a secondary thing with what's going on with Russia and like sort of these new trading blocks that are being formed? And um, it's a really interesting um, thing to evaluate because like does the US actually have the ability to end this quickly and promptly and restore it as a now that they've kind of picked the fight and this has happened. And I think that that's something that we maybe necessarily haven't faced is like I do think that the geopolitical setup, if you go back and look at all of those oil price shocks previously, the geopolitical setup is very different than
Oh
it
yeah.
was right now. I mean, you have you know, China by some metrics larger than the US economy in certain production capacities. And that's not to just say that, you know, that they are maybe economically more powerful, but it could also say that they're economically more vulnerable because, you know, they're consuming goods equally subject to inflation, et cetera. Like I do think that the ripple effects of this really wearing down a lot of other economies in the world and grinding them to a halt is also the piece that really fascinates me. Like, is this the setup for probably a violent global recession? I think so,
Yeah.
right? Like, I don't know. I mean, like,
You're such a bear, Dan. You're such a
I
bear.
can't, I don't
But
know,
nah.
but I like, you know, everybody's like, oh, rates are going to go up. It's like, I mean, I think the economy is going to get really bad
Yeah.
and probably
I
rates are
think
going
the
to come down.
economy is going to get too bad that they
Yeah.
won't. I mean, worst case rates are staying as is.
Yeah.
That's my base case. I mean, the setup right now, I know you're familiar with the fort turning, but I think
Yeah.
we're living it right now. I think
Yeah. We
that's
got to,
just a,
yeah.
yeah. And
It
for
is
those
eerie, like
listening,
reading the original book, like when he taught,
mhm,
like he nails, like I think it's in chapter 6. He's like literally nails like Russia Ukraine conflict, like
yeah.
the oil conflict. He even like nailed the pandemic. It's like eerie to read that because it was written in
Mhm.
like the mid '90s, right?
Oh yeah,
So
and if you're not feeling like reading, just get the audiobook. It's
yeah, that's what I
available
did.
on audiobook too. So really
Have
worth
you read the new one?
reading. No, I haven't. So
Yeah, it's
it's
good.
on my to do.
Yeah, it's really
Um,
really good.
yeah, they updated it, but I think we have the same kind of setup like in history. If people know their history, they can go back. Like we are in this setup where there is still people can argue otherwise, but I think the one superpower is still the US,
Hmm.
but you have some emerging powers that are not far behind. Where the last 40, 50 years, 60, or actually post Second World War, the US was the undisputed, um, un, you know what I'm trying to say. It's the French coming out, but it was
Yeah,
the de facto superpower and hegemon in the
yeah,
world. There was no contest. Sure, Russia tried a little bit, but I think the U.S. was, especially with hindsight 2020, the U.S. was still the clear one driving the world order, and now we're just seeing that path. And I think middling powers, I think let's just say Canada's a middling power. Here you have Canada, most of Western Europe, Australia, kind of these middling powers. I think they're really fighting to find their place in the world, but I think most countries are realizing that you have to be self-sufficient as
yeah.
much as you can be. And I think this is something that Larry Fink said in the latest BlackRock um, presentation or earnings call. He said more and more that's what they're hearing from the clients is countries are looking to be self-sufficient, and we can just go back at the beginning of COVID, and I think that was a wake-up call, but we're getting that even more so right now. If you had in the 2022 when Russia invaded Ukraine and then the US sanction, I mean, all of these things with COVID, the PPEs all being made in China, all the critical equipment that China makes, I think you're seeing more and more countries saying, okay, we have to bring back that home, not just the US. We have to be as self sufficient as we can because we cannot rely on our traditional trading partners. And I think this is what you're going to see. And I really think one of the best ways to invest right now is just think, okay, what does well in a wartime economy?
Right. And when you think about that, like what is it? Because I mean, real estate has actually performed decently well as an asset class, especially like productive when you think about like productive real estate right now. Like housing isn't productive real estate, so I'm not going to try and create a bull case for housing here. I think, the case for housing is, we're in a recession, interest rates come down, borrowers maybe some capitalize on the improved buying power, but it doesn't get distributed evenly because the more people are losing jobs typically in a recession. And so if your unemployment rate rises, I mean, I can pull up a chart from Canadian Bankers Association. Unemployment rate tracks your mortgage delinquency rate pretty strongly. And so housing, I think, would be, you kind of it'll net out. Like, yeah, you'll get rates to come down and that'll improve the borrowing power, but that's probably more stimulative for borrowers who are existing, and maybe some buyers who wanted to buy, who maybe come off the sidelines because they're really confident about their job situation. But I think the probably more powerful
Yeah.
factor is that there's so few buyers who are confident about their job situation in the current economy. When you have AI, you have trade war, where we're already seeing a lot of Canadian producers contracting their workforce and moving to the US in many cases, especially in the auto sector. Um,
Yeah, because I really want to buy a house when I have uncertainty about my
yeah, yeah,
employment or I lose
exactly.
my job, right? Like,
Right.
oh, interest rates are historically low,
Yeah.
doesn't
Yeah.
matter at all, right? I think a lot of people just think, and obviously, the real estate industry is notorious at pumping that. They just pump in lower interest rates,
Yeah.
like it'll solve
Yeah, but it's like,
everything.
why do we have low interest rates, right? Like
Exactly.
everyone's like, rates
That's
are going
it.
to get cut. It's like, well, if rates are getting cut, that means that the economy's bad, and like that's not bullish. As far as I can tell, recessions aren't super bullish. But like the part that you mentioned, like you get a increase in borrowing power, but like let's just say all of your
Mhm.
consumers, you have all of these buyers, pent up
Yeah.
demand that we're
But
hearing
what if you can't
the
borrow? Is there,
Exactly. So
yeah.
you have a improvement in borrowing power. So you can just take this, like, what's your total TAM, like total addressable market of
Yeah.
real estate buyers in the market, right? It grows because their borrowing power, the number of dollars that they can spend, probably grows. But then it shrinks because the number of borrowers probably shrinks because there's people who are losing jobs that can no longer qualify for mortgages and actually maybe become net sellers. And you actually are more likely to see distressed supply than excess demand come as a result of just purely an interest rate play. These things take a long time, right? Like people, and this would,
Mhm.
like,
Yeah.
originally when before we had a couple of new variables added to the equation, obviously trade war and then now real war. My forecast probably would have been that we would see the market bottom towards the end of this year, early next year. You'd see a flat period for a while, and then you'd start to see some recovery thereafter. This would definitely push that out for me on the real estate asset class. And so I think that, people who are looking to make investments or purchase their first home, like if I'm in that position, I'm very confident that time is on my side. I mean, rents are trending down, so my sunk cost of not owning is diminishing, and I can get a decent return in the equity space, even if I'm like just indexes or whatever it is. Probably get a better return than real estate, as long as I'm prudent and actually saving the monthly cost that I would have burned on interest and investing my down payment and whatever it is. So if my advice, and this cost me money to make this recommendation, because I could do a deal with you and I could sell you the home that you want to buy and make some money, is that you're going to wait. And I think we've seen consumers. I mean, the Canadian Real Estate Association stats just came out yesterday. Home sales were now, so last year, just for context, last year was one of the worst years in Canadian history for real estate. So far this year, for the first quarter, so quarter over quarter or year over year for Q1 of last year, were worse. Every single month
What
was
about
below.
pent up demand?
Oh yeah, I mean, I don't know, like, but the thing about like, and this is where it's such a worthwhile discussion, right? Because the idea of pent up demand is like they talk about it as if it's like this thing that you just load into a slingshot and then
Yeah.
it just gets
It's like a
keeps getting
mythical
pulled back further.
creature.
Yeah,
Yeah.
and then they just let it go and it fires at the market in one shot. But the reality is that as the economy changes, you get it trickles out, right? So you get some buyers who say, oh yeah, prices are down, and I don't think I found the perfect house, because it's a deal by deal. It's like a stock where
Mm.
you're buying it at market value. It's very deal by deal. It's very qualitative. Has like it's a consumption good, but it's also an investment good for most people. I don't really consider it an investment, but most Canadians do. I think 70% of Canadians consider their home an investment. But this pent up demand isn't like, it's not a slingshot, right? And it'll trickle out as rates come down, as prices come down, as homeownership becomes more accessible for certain tranches of buyers. They re-enter the market, and you've seen some of those trickle out. The people who are going to get help from bank of mom and dad, borrow a down
Yeah.
payment, get a cosigner, and then it's kind of stopped because we've hit sort of your marginal buyer who can't afford houses in most markets in Canada, and they don't have the confidence to buy. I'll leave it kind of with the one last piece here, which is that this is why I think economists are so concerned about the idea of deflation, right? Deflation psychology. Like, Canadians have a really high inflation psychology. Central bank Governor Gordon Thiessen mentioned this in like the 90s recession, where he talked about how we're more likely to it's like the pivot paradox, right? We're more likely to buy things, front load buying things. Like, we like to take on debt and buy things. We hate deferring gratification. So we're more likely to buy things in fear of inflation going up. And the same would be true for the downside. If we think that prices are going to fall, we would have a pretty strong deflation psychology. So why would I buy something if every single month I see that the price keeps going down?
Yeah.
When will it get to a
Well, it's
point
like the
where
pendulum, right? Like a lot
yeah.
of things in the markets, like it went too far off on one side for various reasons.
Mhm.
That easy money, plenty of money out there, FOMO peaked in early 2022, and it's now the pendulum is starting to really, like, I'm trying to make, like, really go the other way around, right? So,
Mhm.
and at some point it's going to get way too overdone from the other side, and then it's going to start shifting back. That's always how it works. But yeah, if you're a buyer, you don't have that FOMO anymore. You can
Mhm.
just be like, if
And you
you're
haven't for
buying a
years.
house, just be ruthless. That's what
Yeah.
my best tip.
Yeah, and you haven't had that in for years, right? Like, sellers haven't
Mhm.
had bargaining power for years in Canadian real estate, because prices are falling. There's excess supply. There's more added supply coming on the market. You can see it, like, it's just math, right? You have all these mortgages renewing at higher rates. We know that we see unemployment rising, which we know increases delinquency rates. We have the mortgage renewal wall coming. I don't know if you saw the statement from OSFI, but like, they had like something like concern of 150,000 borrowers experiencing mortgage stress. I'll pull up the article here,
Yeah, I
as
mean,
a
I
result
saw
of the
their
renewal wall.
I think their risk assessment.
Yeah.
Yeah.
Yeah. So,
Mm.
they, as many as 150,000 Canadian borrowers will have trouble refinancing their mortgages over the next 2 years, as they face a combination of declining home values and higher interest rates, according to the country's top banking regulator. So, is that bullish for real estate? I don't, that's, my math says probably not. Right. So, um, this is where I think, like, patience has rewarded many investors in both my sector and your sector, I think, but especially in mine. Like, we're
I'm
still in
sure
a
you'll
gradual
see some
repricing.
realtors making some mental gymnastics
Oh yeah.
to say
Oh
how
yeah.
somehow this is bullish. But So, what's your thought? And not to get too much in politics, but clearly, I think that is a wild card with the
Hmm.
Liberals becoming a majority government. I mean,
Yeah,
you could see Carney going full on and do some massive spending for
for sure.
infrastructure projects over the next couple of years, and I think that is a wild card,
Yeah.
and just almost bypassing for emergency reason. I'm not an expert in politics and all the laws behind it and what they have to follow, but with a majority government, I wouldn't be surprised if they really push through some major infrastructure projects first to help the economy, and
Well, and
second to
taxes, like
really,
just
yeah.
yeah. I mean, just not to interrupt you, I apologize, but
Mhm.
the
No,
like
that's okay.
like the GST HST rebate wasn't in the budget.
Mhm.
So we're already seeing this, and now the gas tax removal wasn't in the budget,
Yeah.
so we're already seeing emergency
They're
spending
gonna
that's going
blow out
outside of.
that
Of course they're
forecast.
going to. Like so the deficit, like so we already were looking at a record deficit. And so both, like, let's just set aside the politics first. Both parties were behaving as though the economy was going to need stimulus, right? Like both parties were proposing record deficits. Not This isn't even just a red
Mhm.
versus blue thing.
No, no, exactly.
Um
I'm not.
yeah.
Look.
No, yeah, but I just think it's interesting
Mhm.
because like so even before that, we knew that both parties were running on a platform that they believed that the economy was going to need stimulus within 4 years, like sufficiently enough that we needed whatever. I think Pierre's deficit was in the 60s and Carney's was 70. So and now yeah, now we're obviously exceeding that because we've just dropped the tax revenue massively on GST, HST in the province of Ontario and at a national level on new homes. We've got gas tax waived for a short period of time. So are they going to like it doesn't even have to be infrastructure. Yeah, of course, during historic recession periods, you see make work projects where they're spending a ton of money on infrastructure and God knows we could use better infrastructure in this country. So I'm not unhappy to see that. But at what cost, right? Like we're borrowing from the future of Canada's economy. Does this become a bit of a debt crisis issue? Does this become increases in long-term borrowing rates in our country where we can't really afford that because our consumers are so levered up? Like, yeah, I mean, those are the real concerns from my perspective.
Yeah, I mean, I can see both sides. I'm not a fan of just spending beyond our means, but if we've seen anything with the Strait of Hormuz and the oil shock right now and the changing geopolitical order, if we had better infrastructure to get Alberta's oil to the coasts, and be less reliant on the US, like Canada as a country could really benefit from that and be able to not only help Alberta, but being able to get the additional revenue to invest elsewhere. So I think that is something I do hope to see. And at the end of the day, I'm just kind of resigned to the fact that we'll be spending a lot more money one way or another.
Are
So,
are you optimistic that the government can like capture that moment? Like, because it could be argued from either direction, right? And like I really try and be nonpartisan in these things
yeah,
because I want to I like really want to fully explore the thought experiments, right? So
yeah,
you've got Carney who obviously is globally connected, and I know a lot of people like to say like oh yeah, like crony capitalism, like it's gonna be all his buddies and stuff. It's like, well, where were you when, like, I mean, if you're arguing that, it's probably because you're
yeah.
a
I mean,
political opponent, right? So but where were you when Trump was doing the same thing? Like, I'm personally not I honestly don't have a huge issue with people leveraging their networks to improve the outcomes and results that happen within a country of any type, right? So
plus,
I'm
let's
not.
not be naive. Like it's gonna happen with every fucking
Right.
party in
Right.
power. Like
Exactly. Yeah.
that's
That's how
always what I
politics
come
works. Yeah.
back. Exactly. Like that's how it's gonna work. And if you think like if you don't think it's going to happen with every single party, let's wait like 30 years and then we'll
Yeah.
find out about it afterwards.
Exactly.
So yeah, I mean, I think Carney's a pragmatic. I mean, he
Yeah.
stole stuff from Pierre Poilievre in his campaign and
Yeah.
is more
Yeah.
than happy to like put it in practice. Like, I
Yeah.
really think he's a pragmatic. Do I like everything he does? Of course not.
No, yeah. Yeah. And I
I'm
think for me, the issue is like, I mean, I think Canadians are right to have lost faith in the red team and their ability to deliver. And he's still working with that cabinet that was assembled by
yeah.
Trudeau. And that's obviously like, you can't ignore that one. Like Canadians are right to have trust issues in this
Oh
regard.
yeah.
But I would say like from an individual leadership perspective, it fascinates me because like when you mentioned the policy piece, it's like, oh, he's stealing all of Pierre's policies. It's like, well, didn't you like them? Like, aren't they good
Yeah.
policies? Like, and if he
Exactly.
gets if
Yeah.
he gets in and the policies get enacted, like, isn't that actually a net
Mhm.
positive? thing, right? The other thing that I think is interesting, and then sorry, I apologize, I keep interrupting you, but
That's
um,
okay.
is that they were running very similar platforms. Like by the time the election was actually decided, the platforms were not far off from one another. You know, there was a couple of like little nuances in tax policy structures on the housing file, which was one of the big things that it was focused on beyond trade war, and so we actually have a moment of alignment between both the right and left in Canada. I think. Well, I mean, both parties are liberal. Let's say that to start, right? But you know the if the platforms were similar and 80, I think it was over 80, it was 84% of Canadians voted for either the CPC or the LPC. So
Yeah, that would make
the
sense. Yeah.
the highest number, it was the most two-sided election ever. Like usually it's more into the other parties. That means that like if their platforms were similar and 84% of Canadian voters voted for similar platforms, that we're like we have a historic alignment on how much Canadians agree on the issues that were on
Yeah.
the platform. Yet you go out and like read my Instagram comments or like discourse on social media, and it feels like we're like the most divided that we've ever been because people are being told, you know, by politicians that we should hate one
Mhm.
another. But the reality is, it seems like we're actually more on the same page that we have been in a really long time.
Yeah, I mean, but it's better content if people are more
Of
divided, right?
course,
Like you
yeah,
get
yeah. Divide and
more
conquer too,
emotions
right?
in. Yeah, exactly. So it's, I mean, I'm not surprised, but I'll be fascinated to see what happens because obviously, to me, I think this majority changes everything. It does give him
Mhm.
some more legitimacy. Where I think some conservatives will argue that no, it doesn't because people didn't vote for that and there were
Yeah,
defections, and
yeah,
I get that, whatever, but it does bring legitimacy when you're starting to negotiate with business leaders,
right.
with foreign governments, whatever you name it. Sure, maybe in Canada some people feel slighted because they didn't vote
Yeah.
for that
And
in
I don't
their
think that's
MP.
unreasonable. Like it is definitely
No.
it's not a
Mhm.
maybe not a positive step in like
Yeah.
maybe not a
But if you
positive
want
step
to invest,
for
if you're like a
democracy.
major, if your company wants to, be a partner in a new
Yeah.
pipeline, like, are you not more likely to go ahead and be willing to do it if you're with a majority government that is clearly indicating that they want to,
Well,
support the project,
I think
than a minority
discussions
government? Yeah.
yeah, like discussions advance a lot faster when you're actually sitting
Hmm.
with somebody who has the signing authority, right? Whereas it doesn't have
Exactly.
to go to
Yeah.
go to to parliament or whatever, right? So
Hmm.
yeah, no, you're absolutely right. Absolutely right. So then what happens? Are we going to see pipelines?
I don't know. I mean, I think I haven't seen any recent surveys, but I think Quebec's always been, and I grew up in Quebec, so for Quebec listeners here, I love the province. My parents live on the Quebec side here, but I think sentiment had switched over the last year with Quebec. I haven't seen any recent surveys ever since the Strait of Hormuz, but
Yeah.
I would think that Quebecers are becoming more and more favorable to
I'll pull
a
up the most recent
pipeline.
one I can
Yeah.
find. Yeah, which is, I
Yeah.
mean,
What
yeah,
was
Quebec
that?
obviously is always the X factor, but this was 2025, end of 2025, so not too long ago.
Okay.
And Quebec was majority support, right? Was that 50%?
Yeah.
So I
Strong.
mean, I
Yeah.
guess not
And
majority, just shy
I
of it.
would
Yeah,
probably assume that it's higher now with what they're
yeah,
seeing. Because
yeah.
yeah, I mean, Quebecers are not stupid. They might want more clean energy, and of course they're filled with hydro and for hydroelectricity. But I still think a lot of people that were maybe more on the energy transition are realizing that okay, it's energy security is more important than energy transition, right? So
Right.
if we can achieve both, great. But let's be pragmatic about it. Can we really remove fossil fuel? And should we not take advantage of our enviable situation compared to other countries in the world? We probably should.
Yeah. Yeah, an interesting thing that got on my radar is this recent report from RBC as well. Is that you know, beyond just like fossil fuels on the energy side, they identified some strength for Canada, obviously, to um, I think they have here oil and gas 705 billion, so put pipelines, LNG terminals, et cetera. Electricity 670 billion, agriculture and food, 205 billion, metals and minerals, 200 billion. And it's actually a really good research note. And I think that, there's this moment where capital is looking for safer places to be, as a result
Hmm.
of things that are happening. And it's like, is there a moment, and can we capture it in Canada? And I don't know, like I
I'm
makes
gonna
you
say it's as good as it can be right now.
right.
Canada is not perfect, and I know a lot of people will say Canada is broken, but
I
that
would
Middle
agree with
East
that. Like
money,
for, I would
yeah,
agree with that for like for domestic Canadians, and like this is probably
yeah,
one of the easiest places for people to criticize, like an outcome of Carney versus Polyev is, Polyev was clearly focused on the issues that were impacting Canadians on a day to day basis. Carney's obviously very much more focused on issues that are impacting Canada on a global scale. Um, can we capture the investment as a result of his leadership, because of the connections and sort of
yeah,
the
reputation, and
yeah,
yeah.
yeah, probably. Is it likely to come at the expense of maybe ignoring the GDP per capita and sort of like issues that Canadians are facing on a main street level? I mean, it seems to be pretty on brand for the Liberal Party to do that over the last little bit. So could this mean like growth in GDP but still continuing decline in GDP per capita? It wouldn't surprise me, right? So like that's my best attempt at a realistic
But
outcome there.
also, does Canada look like a really terrible place to invest right now
Yeah. Yeah, I
compared
don't
to
think
other
so.
places in the
I know.
world? Like,
Yeah.
just think about it. Europe's a shit show, and then you have the Middle East where, do you want to invest in Dubai right now? Probably not. So if you're a foreign investor and you're pretty open to where to invest, um, sure, the US could be an attractive place, but Canada right next door to the US. And I happen to think that regardless of the differences Canada and the US have right now on the trade front, I think 5, 10 years down the line will be very close, as close, if not closer, economically. I think that's what you're going to see more and more is you're going
Yeah.
to see spheres of influence in the world
Yeah.
where the US will have a bigger influence on the Americas, probably step
The new
back
trading
into,
blocks, right?
yeah, exactly. New trading blocks. Obviously, it doesn't look like it's happening right now with
No.
how much they're intervening everywhere. But yeah, that's my base case. Is yeah, Canada is very strategically positioned next to the U.S. And as much as it may seem like not the case, I think it's going to get better over the next 5, 10 years.
Well, I mean, if we're to look at like previous conflicts in the Middle East, or like even like any wars of this nature that the U.S. kind of entered without real public support, and sort of like never really being on the radar during the election period, um, they they had historically in the last few. I think if you think of like Afghanistan, even if you go to like Vietnam, et cetera, Gulf War, kind of end up like um, eventually ending it sort of in a not a like doesn't look like a successful outcome, and that uh, kind of leads to a period of step back. Like, hey, maybe we should just focus on our own shit for a little bit, and back home, and really build this up here, and not maybe try and leverage the military industrial complex to stimulate our way out of a recession, or whatever, or whatever it is, right? Like,
Hmm.
um, so if we were to assume that history rhymes, and maybe those outcomes, like if you again go back and look at all of those previous conflicts, go back and look at all those previous oil price spikes, if they end in a similar fashion, what does that look like to this idea of global hegemony, but also the new trading blocks that are forming? I think it pushes more towards the thesis that you're mentioning, which is, yeah, like maybe there's some intervention now, and they're trying to step outside of this, but
Yeah.
it maybe teaches them a lesson. Like, going on a side quest right now, it's like maybe I should just get back on the main quest, which is, establishing this trading block that was doing exceptionally well in my part of the world.
Yeah, no, no, exactly. I don't have too much else to add. I think anything you want to finish on before we wrap this up, I'll have to leave in about 10 minutes. Yeah.
Yeah, no, nothing specifically. Like, I think, I guess like it seems like we're aligned on interest rates. So maybe we'll
Mm,
just try and like summarize everything. It seems like we're aligned on interest rates. Like, yeah, there's going to be,
yeah.
interest rates act like they want to go up in the short term, but they're more likely to come down as a result. If oil prices
Yeah.
stay high, that's going to lead to demand destruction. So you get short term inflation, long term recession. Rates probably coming more likely to be down in 12 months than up from where they are right now. Um, trade war, I think, is probably the one thing we didn't really discuss a ton, but
Yeah.
it seems like that's sort of like been ignored, right? And maybe we can just cover that. For those people listening, we're going to be doing these every week, I think. So every
Mhm.
single Friday, we're going to do these.
And maybe
And
like we have some guests on too if there's
yeah,
a
yeah,
certain
yeah. If you
topic
can
we can
recommend anybody,
reach out to someone, have a guest on too. So we're kind of just playing with the
it's
format.
fluid.
We'll
It's a
do.
living, breathing thing.
Yeah,
Yeah,
exactly. So whatever people enjoy and we have fun doing, that's it.
yeah, 100%. Okay. Well, yeah. For those of you who tuned in live, really appreciate it. Thanks a lot for taking the time to listen. For those of you who are listening to the recording, these are going to be, I think, Friday lunch. That's our goal, right? I think a lot of people Friday's the biggest work from home day, so hoping you can just
Yeah.
tune in while you're working and watch our ugly faces on your screen and talk about macro for a little bit. And for the couple of you who left us comments and questions and stuff, I really appreciate it. That's Stuart. I think Stuart Sulfur 1375, and then
Yeah.
DBW 9976. We'll feel free to like fire us questions and we'll try and answer them live as well. And really just want to try and get the audience for both of our shows a little bit more engaged and
Mhm.
have a little fun in the process. Like I know you and I just like to riff on macro. Like we do. I feel like we every time we are on a phone call, like before
We just
our
end
version of
up,
small
yeah.
talk is like let's just talk macro for like 10 or 15 minutes before. So we were just like, oh, we'll make that a public forum. So
Mhm.
yeah, I mean, I think that's it from my end.
Yeah, no, I think, and I know a lot of people have been asking. I met with a friend yesterday and was asking me to look at his investment portfolio. And I've talked about it on the podcast quite a bit, but I think people have to take a step back and just not automatically assume that what happened the last 15, 20, 30 years will be what will be happening in the next
Yeah.
10 years. I know people will laugh at the idea that it's different this time, but again, if we start thinking about the fort turning and everything we've seen in the
hmm
last year and a half, like yes, it's different this time. Like
I
I
would see
don't
I can
know.
see if we can get that guy on here, the fourth
Yeah.
turning. I know somebody who knows him actually. So but
Okay.
yeah.
No, but I mean, for me, like I look at it, I want to think about what could potentially happen and all the uncertainty around it. And I try to position a portfolio like that. When I see people
Yeah.
on Twitter that are like 100% in tech stock, I'm like, you will either get your face ripped off completely or you'll do good. But, it's going to be one or the other. And again, there's no guarantee that tech will keep ripping. And just to come back to maybe we can finish on this, but the wartime economy. So I
Yeah.
think, when you start thinking about obviously the defense industry, if you start thinking about commodities, oil producers, of course, in Canada should end up doing well. So all these kind of industries, I think production industries, not that we have that many left, fertilizer company like
hmm
Nutrients should do pretty
Well,
well too. Yeah.
yeah, fertilizer prices like went crazy, which is pretty bullish for
Yeah.
Sask, right? I think Saskatchewan's like
Yeah.
the biggest trading partner with India, or they're like 90% of their fertilizer goes to India, I believe, or like
Is
80%.
it?
So
Yeah, I didn't know
yeah,
that. But I mean, obviously with the Nutrien, they have not only I
yeah,
think it's potash, phosphate, and
yeah,
nitrogen that are a big producer of that. So
yeah,
that would be the other effect of the current
yeah.
strait being closed, is that we're not talking about enough. Is it could really impact some planting season and harvesting seasons in the next months to come, and have some big issues worldwide. So I wouldn't be surprised if we start seeing food prices elevate if you start combining that with higher diesel prices, for example.
Yeah. Yeah. The last thing I'll leave people with, because I know we touched a little bit on AI and we touched a little bit on trade war. Like we're going to try and maybe have a little bit more focused topics for some of these. So we'll cover each of those in like separate lives. So I think maybe it'd be cool to do next week. Like, is the trade war still a thing? Right? Like, is it just kind of completely
Yeah.
taking a backseat? And
Hmm.
we'll talk a little bit about Kuzma and kind of the that being a big question mark, obviously, on Canada's economy heading into June. And then also, I think AI is another big one. Maybe we can try and get Braden on for that to chat with us, because he's obviously very embedded in that space. I'm pretty embedded in that space with the brokerage, like the real estate
Hmm.
brokerage that I'm at builds technology tools for the industry. Um, but I think I'm not super sold on the AI bear case, and so we'll chat, because I'm interested to talk a little bit about it. But
Yeah.
we'll leave that as a teaser, because I know you got to jump. But yeah, thanks a lot for listening, everybody.
Okay. Yeah. Thanks, everyone.